Welcome back to NYSE TV Live. Twice a year, the New York Stock Exchange hosts tech summits in the world's biggest hubs for innovation. That's New York and San Francisco. Well, today, the SF Tech Summit is underway. And to get a pulse on the tech landscape and hear more about its latest fund, I was joined by one of the premier venture capital firms. That's Lerer Hippeau. Here's what its co-founder and managing partner, Eric Hippeau, had to share.
Our ninth funds. We also have 4 growth funds, so we've been very active, and it also marks our 15th anniversary. So we've been the most active early stage investor in New York for 15 years now. Time really flies. I'm really shocked. It's gone so fast. And we're incredibly excited. It's a particularly incredible moment to be making investments and backing founders, backing entrepreneurs, because of what's going on in technology today.
What is top of mind for you when it comes to putting this new money, $200 million, to work?
Top of mind is to find the very best teams, the very best founders. That's our number one approach, is to find people who are really exceptional, who are going to be able to build innovative, large companies. And then we look at what they're trying to accomplish, their idea. Is it a big idea? Is it going to change the world in one way or the other? So that's been our kind of North Star from the very beginning, finding the very best entrepreneurs.
15 years in, that's how long Lerer Hippeau has been around, coincides in many ways with the start of the New York City tech scene on the startup stage. What have you learned over these 15 years?
Yes, New York is, New York is New York, right? People want to be here. New York attracts talent. In the past 15 years, the tech industry has become, one of the major segments for employment for new companies. Financial services are still very much the driver, but tech is kind of shortly behind. And if you look at all the big tech companies, Google, Meta, Amazon, and everybody has thousands and thousands of employees. Here in New York, 15 years ago, they had almost nobody. And so, we've invested in over 400 companies during that time. The great majority of them are here in New York. Over 200 of them are here in New York. So we have this amazing network of startup companies that are attached to us, attached to our platform.
How has your investment process evolved over the years?
Essentially remained the same. We're seed-first investors, so our first money is always at the seed level in companies that are just about to go to market. In some cases, just in market. They've developed a product. They have a small team. They have an approach towards go to market. And then the majority of, as I mentioned before, the majority are in New York. Our entire team is here in New York. Our focus is in New York, but we do invest in other places in the United States. But our focus is what's going on in New York.
Are you optimistic about the New York tech scene going forward?
Very much so. Very much so. We think that New York will continue to be technology in New York will continue to be a driver in terms of new companies, employment. We continue to see an influx of people, including from the West Coast, from other parts of the country, of people who want to be part of our community, part of this incredibly rich tech community here.
We're here at the New York Stock Exchange. Many companies that begin as startups make their way through multiple funding rounds, and eventually they can tap the capital markets here, the public markets, through an IPO at the NYSE. What do you want to see when it comes to the life cycle of these companies that you invest in early on?
The big trend in the past 15 years, again, is that there's been this massive influx of private capital, not only obviously in venture, but also in private equity. And so companies now have access to more and more private capital. It means that they can stay private longer. And in many cases, companies stay private for 8 years, 10 years, 12 years. It used to be a much shorter period of time. And so what we would like to see is more IPOs. We would like to see facilitation in terms of getting
companies people out the door.
Yeah, people just need to go public sooner because it's we are very early in stage investors. So we used to hold our companies for 5, 6, 7 years. Now we hold them for 8, 10, 12 years. We need to return capital to our investors, our own LPs. Early employees need a public market so that they can, they all have received options or shares. They all need to start to be able to liquidate some of these shares for life events. So it benefits everyone if companies could go public sooner.
We're speaking in the middle of May of 2025, and this year does mark change in the sense of a new administration, of course, a new cabinet, and new officials that we see in D.C. creating the policy that can affect every investment ecosystem across the board, from public to private companies. What do you think this new SEC chair might mean for the life cycle, the likelihood of some of these private companies, including ones that you invest in, to tap the capital markets?
The new administration is very pro-business. So the hope then is that the SEC will, under this new administration, look at the conditions that it takes for companies to go public. It's quite burdensome. It's also quite expensive. So if we can lighten up these regulations and make it less expensive to go public. At the same time, the public investors need to get re-engaged at an earlier stage with innovative companies that are exciting, companies that they should be buying earlier than they're buying today. Today, one talks about the big tech, the big 7 tech companies, but these are very expensive. They're worth trillions of dollars. How about looking at companies that are worth maybe $500 million, $1 billion, a couple $1 billion, that will grow into these massive companies? That's where public investors, in my opinion, should be looking at and saying, hey, we need more of these companies. We need to be able to invest in more of these companies.
We see, as we're speaking now, the S&P 500 within striking distance of an all-time high, was last at a record in mid to late February. But of course, it's been a volatile stretch the past few months, and that includes with higher than expected tariffs announced by President Donald Trump on April 2nd. Amid this choppiness, how are you helping the companies that you invest in navigate change?
Our companies, by and large, are not affected by tariffs because they tend to be asset-light, software-based companies or AI-based companies. We do have robotics companies and other companies where their supply chain comes from China. And for the most part, they have gotten themselves prepared by building more inventory, hoping that this is just a moment in time. Tariffs, in general, are not good for capitalism. You want an open market. You want open competition. You want freedom of goods and movement. And so our companies get affected by tariffs just simply by the general mood. As you saw in the past few weeks, the stock market went sour on the idea that the tariffs would stay in place. Now it's rebounding again simply because the tariffs, at least, are being temporarily lifted. So that shows you that the market wants an open trade. They want the freedom of people doing what they need to do.
All right, thanks again to Hippeau, co-founder and managing partner at Lerer Hippeau.